us live, and we'll just kind of let people trickle into the room. All right. And just so you know, I think there's about a 30-second delay, 20-second delay from when we talk and when it actually appears on the YouTube.
Okay. Sounds good to me. So I'm just organizing notes.
Yeah, yeah.
Crazy day in the markets.
Yeah. What did the S&P end up?
Oh, I don't know. It was so volatile. I mean, Powell said one thing and everyone was happy, and then said another thing and sad. It was pretty. It was fun. It was honestly kind of entertaining, but yeah. Ended up down 1.5%.
Eggshells these days, you know.
And it's all over. Are we going to cut 3 months earlier or 3 months later? I don't know.
It's so funny because, you know, a couple of months ago, the probability of a rate cut in March was like 75 to 80 something percent. And now it's like 40%. I mean, those people were so sure of this rate, 6 to 7 cuts. I mean, that's just, you know, just dead wrong. There's no way to put it.
Yeah.
Yeah.
I think we'll probably get like 3 or 4, but I mean, we'll see a few data points and could change in a whim.
Yeah. Oh, yeah. I mean, economics is a social science, right? I mean, and the irony is that the Fed itself gets second guessed by the market, you know, which sounds totally weird. The market's guessing what the Fed will do, but sometimes the market is right. So nobody really knows.
Yeah. Yeah, that's fair.
I mean, we've still got this really strong economy, and it's just everybody's been calling for this recession forever, and it just hasn't happened. And I'm not saying it won't. I'm not saying it won't, but you know, all these doomsayers, and the same thing happened after 2008, 2009 financial crisis. I don't know if you were investing at that time, but people were like, "Oh gosh, you know, these central banks, they're printing all this money. They're pumping all this liquidity into the economy. It's going to destroy the dollar. It's going to destroy, you know, the developed markets." Completely false. None of that happened. The U.S. dollar went up and up and up and up and up. Like all those articles. And I look back at some of these headlines. I mean, and these people are still saying the same stuff. Like, you know, for the past 15 years, they've been saying the same doom and gloom. I'm not saying they'll never be right, but there are a lot of people in this space whose job it is to say the same stuff over and over and hope one of these days, like a stopped clock, they're going to be right.
I was just about to use that saying, beat me to it.
Yeah. Yeah, it's funny. Yeah, especially gold, the gold. I'm not a gold, but I own a little bit of gold as a diversification thing. I'm not a gold bug, but these gold dudes, I mean, they are just bonkers. You know, the religious ones, and gold 15,000 an ounce, gold 50,000, gold 100,000 an ounce. I mean, some of these people, I went back and for a Forbes article, and I traced their predictions, and like I won't name this guy's name on air, but some of these guys have been literally for the same 15 years, the same predictions between anywhere from 15 to 50 to $100,000 an ounce. And gold is basically, you know, 1,200 an ounce, right? It's not done terribly all the time, but it's just been completely wrong. And there are people who buy into that. So a little scary. Yep. So, all right. So, okay. 7:59 Eastern. So I'll wait 1 minute to keep us on the exact time schedule, and then we'll get rolling. Okay, so 8 o'clock, I am going to shift gears to my slide deck. So thank you, guys. Thanks, everyone, for joining us here. I know I have some friends in the audience for sure, and you know who you are. Thank you very much for watching. And if you're a new friend watching, thank you very much as well. We're delighted to be doing this. I'm James Early, Chief Investment Officer here at BBAE, and I am joined by the very honorable, the very dignified Brad Freeman of the stock market. He's the founder of stockmarketnerd.com. You can find him at stockmarketnerd on X/Twitter. And let me just shamelessly promote Brad before he introduces himself a little bit more. He is probably the most knowledgeable person, at least that I have access to, on a wide range of widely held stocks and some smaller stocks too. And he goes really deeper than 99% of investors, including most professional investors, to provide excellent earnings coverage, financial coverage. And we're proud here at BBAE to feature much of Brad's content in our app and our ecosystem. So Brad, thank you very much as well. Brad, can you hear me? Okay, I just want to make sure you're not on mute.
Is it?
Brad, can you hear me okay?
Yep. Yeah,
I froze up.
now.
Okay,
Sorry,
okay.
froze for a second.
Okay, got it. You know, maybe it's when I shift to the other slide page and then I come back again. So, okay, I'm going to try that again. Apologize if anyone's watching and I froze up. So, can you hear me now, Brad, or not?
Yes, sir. Yeah.
Okay, great. So it worked this time. So back to here. So basically, we're going to talk about, this is kind of in reverse chronological order. We're going to take your questions. We're going to do that last. We love your questions. Brad is going to discuss Amazon, Meta, and Uber. These are three of the most widely held stocks in the world, I would say. And he is the man to be doing this. In addition, I will basically talk about the state of the U.S. market. You don't have to read all these words. Three big things that I'm looking at are, how do you play falling interest rates? What happens with small caps? They've been left way behind. And what about emerging markets? Speaking of behind, they've been underperforming since 2011. And are they primed for a reversal? Just a quick disclaimer, we are not giving personal investment advice here. So please do your own research and make your own decisions for your own portfolio. So speaking of disclaimers, investing has tribes, as most of us know. And I'm just going to put my sort of tribal affiliation out here. Brad, you're welcome to as well. Look first at, this is a chart from Morgan Housel. I love Morgan. He and I used to actually work together at Motley Fool years ago. He's a brilliant writer and just a good human being. He has a really great chart, just a book called Shut Up and Wait, showing this chart would basically tell you all you need to know about investing. The S&P 500, or the U.S. market, generally rises alongside the generally growing economic productivity of the economy. So when you buy into stocks, you buy into that earnings power, you buy into that productivity growth of humankind. And in general, humankind has been pretty good at adding value over the long period of time. Okay, so that's the main reason that it's good to index. And I use what I call indexing plus a few. I mean, mostly index, unless you think you can do better. A few more quick reasons. Most managers, as you can see this top quote, 94%, lose to the S&P over a long period of time. It's very hard to beat an index. And one of the reasons is returns in the stock market are very, very concentrated. They're concentrated in terms of number of days. 1.9% of trading days, you miss those, you get 93% lower returns. And by the way, if you miss the 1.9% of worst days, your returns would be like 2,150% higher. So they're concentrated in both directions. And in terms of stocks, Professor Hank Bessembinder at Arizona State University found that 4% of U.S. stocks from 1928 until present accounted for basically all of stock market gains. So in other words, if you hold an index fund for a long period of time, you're diversifying across the number of stocks and across the time period. So you have these wide nets in two different directions. You're more likely to capture all the good stuff and the bad stuff, but in general, it nets out to be good stuff, or at least it has so far. So back to the here and now, I want to pick up a headline that I saw a few days ago, last week, really. It has 2 points that I think really encapsulate the weirdness of the current market. We just hit an all-time high, but a lot of stocks are still in a bear market. That gives us a few thoughts. The first is, I'm going to address the people who say all-time high, because that kind of brings out the best and the worst in humanity. You get some people who say, I want to pile on. I want to chase returns. And you get other people who say, all-time high. Oh my gosh, that means things are going to crash. I need to get out. Well, in general, and I can't predict what this particular market is going to do after this particular all-time high, but in general, the data is on the side of the optimists. This is from Truist, featured by Sam Rowe, who writes an excellent blog, tker.co. In general, the U.S. market goes up 14% in the year following a new high. So last week or so, we had the all-time high. So in theory, in the next 12 months, we, on average, would see a 14% rise. But again, this is not a prediction. It's just a statistical thing. U.S. stocks generally do well, too. And I say this because if you're the kind of person who's thinking year by year, I would argue you're probably doing it wrong. Okay. I tell people invest in the market with money you're not going to need for the next 5 years. It's a long-term thing. At least that's what you tend to need to capture the overall good statistical benefits of long-term investing. This chart here is from Professor Oswath Damodaran of New York University, a great guy. I've met him years ago when he came to Motley Fool. In general, the market goes up 10, maybe a little more than 10% per year in the U.S. Last year, it was up 26%. That was better than, I think, 90-something%. My old eyes can't quite read this. But in general, the U.S. stock market does well. And Bespoke Investment Group found that from 1928, there's never been a 16-year period where the S&P return has not been positive. Now, back to the second part of that headline I mentioned. Many stocks are still in a bear market. Look at this. At least from the past, 10 years, this is the lowest percent of stocks in the S&P actually outperforming the S&P. So we have something weird going on. We have a few big stocks really pulling up the market, and you got a lot of little ones left behind. And I'm going to get to this a little bit later in my second question, but it might have people wondering, is there an opportunity? My first question, though, is just a little more basic. Who's right on interest rates? And Brad and I were just talking about this before we started the live stream. We got this headline at the top. The Fed is predicting 3 rate cuts in 2024. And if you don't know, the S&P rates are like at a 22-year high. We had lots and lots of rate hikes. And in general, people are expecting the Federal Reserve, which is the central bank of the U.S., to start cutting rates this year. Rates are like a gas pedal or a brake pedal for the economy. So lowering interest rates makes it easier to borrow money to buy a house or buy a car or start a business or whatever. And raising rates does the reverse. The discrepancy is on how many cuts we're going to see. The Fed itself has said 3, but the market, at least according to this CME Fed Watch tool, which imputes expectations from changes in futures prices, futures on interest rates, until recently, the market was expecting 6 or 7. So who's right? Now, that's above my pay grade. I don't know. In fact, the irony is if the market was expecting 7, we only have 3, you might have price behavior that is more aligned with a rate hike because rates are ending up a little higher than the market was expecting, or at least pricing in. But in general, if rates do go down, they drop more than expected, here are 3 things to watch for. It's going to be good for pre-existing bonds. If old bonds pay higher rates, and new bonds pay lower rates, nobody's going to want those new bonds. They're going to want the old bonds. It's going to push up the price of the old bonds. Okay. The reverse is true. Obviously, if rates go up, you have an old low paying bond. Nobody's going to want your bond if new bonds pay more. Now, lower rates make U.S. bonds less attractive. And that means less foreign demand for U.S. dollars to buy those U.S. bonds or other U.S. investments. So it tends to push down the dollar. Commodities are priced in dollars. So declining rates tend to be good for commodities. Gold, silver, platinum, whatever, not just metals, but other commodities too. And generally small caps. I'm going to get into this in a minute. Small caps compared to most other stocks have a lot more debt, and they have a lot more debt that is variable rate. And that's one reason they've been left behind recently is they've got this debt, and when rates went up, their interest payments went up too. Not so good. But again, these conditions may be set to reverse. Second question. I just mentioned, will small caps mean revert? The top chart, the blue line, is the regular S&P. The other one is equal weight S&P. And actually, most of these gains came in December. It was basically breaking even at the beginning of December. And then it closed the year. This is through the end of 2023. It closed the year up about 11%, but not as good as 26%. That shows you the magnitude of outperformance of the regular S&P. Here's another chart here. You can see NVIDIA, Meta, these big stocks. And again, Brad's going to talk about some of these in a minute. But the regular S&P 500 looks, even though it had one of its best years ever, its gain looks tiny compared to these big stock gains. S&P 600, you see to the right, is a small cap index. That's even worse. And S&P 600, excuse me, until December 1st, it's basically negligible. So in other words, if you go 2023, but stop it at the beginning of December, you don't have December's returns in there. It was basically flat for the year. So those stocks are not necessarily in a bear market, but at least they're treading water. And so why? Why is that? Well, this is not really why, this is what, again, this is the PE ratio. NASDAQ 100, S&P 500, S&P 600 is cheap. And it's been that way in most of the past 9 years. And so again, investors might be wondering, is there a buying opportunity now in small caps? Look at this. S&P 600 is a small cap index. So is the Russell 2000. Their debt to EBITDA. EBITDA is earnings before interest, taxes, depreciation, and amortization. It's sort of like a kind of bastardized measure of operating income with some bad stuff removed. Their ratios are much higher. They've got a lot more debt. And look at the blue line here on this chart on the right. They've got a lot more floating debt, and a lot more of the small cap firms are unprofitable. So it's really a perfect interest rate storm to knock down small caps. And that's why small caps have not participated in the party. And I don't have a chart for this, but by the way, small cap value is whacked down way more than small cap growth. So even within small caps, the value is a lot cheaper than growth. Now, that's not saying it's going to do a lot better. I'm just saying it's currently a lot cheaper. So if you are a believer in small cap mean reversion, and I'm not telling you what to believe one way or the other, here are, just for information purposes, some of the larger small cap ETFs. It's almost an oxymoron, but not quite. I just literally picked the 4 biggest. In fair disclosure, I own VB, the Vanguard one. I like low fees. My general suggestion, if you're buying an ETF, go for the lowest fees. In general, the high fee ETFs don't justify their fees. Occasionally they may, though. But these are some of the bigger small caps. And then finally, the third question on my mind is, what's going to happen with emerging markets? Here's a chart from AllianceBernstein. The teal color, the blue-green color on the left is the return of emerging markets from 2000 to 2010, 18.5% per year. Everybody fell in love with emerging markets then. Jeremy Siegel, Wharton professor, was telling everybody, put 20, 25% of your portfolio in emerging markets. And he wasn't alone. Many others like him were saying similar things. But since 2011 till the present, emerging markets have returned negative 0.2% per year. So terrible, terrible. But that doesn't stop the media from every year putting out an article saying, will this be the year emerging markets come back? Will this be the year they come back? And so far, it hasn't happened. So far, it hasn't happened. I'm not saying it won't happen. In fact, if the dollar falls again this year, as we talked about, or dollar falls this year, it actually could be the year. I don't think they're going to stay down forever. Emerging markets, skip to number 3 first. They're cheaper than they've ever been, at least on a price to book ratio. This is from a company called Global X, this data. They also account for 80% of GDP growth, but a little bit less than 12% of global market cap. And again, the main catalyst would be falling interest rates. If you look at those great years for emerging markets, and I don't have a chart for this, but just trust me, from 2000 to 2010, a lot of those gains came because the US dollar fell. And then after that, after we had the financial crisis, 2008, 2009, people had this big flight to quality. Even though the US printed a lot of money, people were scared and they put more money in the US. That boosted up the dollar, and there went emerging markets down. So if likewise you're interested in this, again, just presented for information, here are literally the 4 largest. I'm not picking and choosing winners or losers here, just presenting the 4 largest emerging market ETFs. I do own shares in VWO. I've had that for a long time. It wasn't a particular play on this thesis. It's just something I've had for many years, in fact. So that is the James Early pitch. If you have any questions about anything I've said or anything else, please let us know in the chat. We're going to be happy to take your questions. And I think we got a few submitted in advance, and I'm going to answer those a little bit later. In the meantime, I would like to turn over the floor to my friend Brad Freeman. Again, he is the most knowledgeable guy I know on these 3 stocks and on many others. So Brad, I'll let you take it from here, whichever one you want to start with first.
Sure, let's go alphabetically. And thank you so much for the kind words. We were breaking up a little at the beginning, so if I missed a cue or something, I apologize. But without further ado, let's talk about Amazon. So I really want to frame the investment case. And by the way, I should say these are my 3 largest holdings by far. I think they make up over 30% of my overall portfolio. So pretty concentrated and pretty large. So as I say nice things about these companies, just know that I'm a shareholder, and so I'm not entirely unbiased. But when it comes to Amazon, I really want to frame the question, or frame the conversation around two things, and two pretty big ideas in terms of demand and margin. So starting with demand, Amazon sentiment kind of fell pretty deeply out of favor early-ish in 2023. And I'm not sure where it touched about $80 a share or something like that, and it's about doubled since then. But there were really two concerns and two structural tailwinds that power Amazon's business that people were a big concern about. And one of them was e-commerce, and the fact that we were lapping this massive multi-year pandemic pull forward, and now comps were immensely difficult as money was getting more expensive, as James talked about, as the consumer was becoming more fragile, as it often does as money gets more expensive, and as again comps were just pulling or comping against what we were pulling forward for multiple years. So when you can't go to shop in a store, obviously e-commerce is going to boom. But the other one is cloud computing, and when the economy turned a bit, and cloud computing is more durable against these factors than a lot of segments, but it's not immune. When the economy turned a bit, companies rightfully went into belt tightening mode. Where can I cut costs? Or the buzzword within cloud computing is where can I optimize workloads? Or I guess a cloud term because it's two words, my mistake. But it doesn't really matter. But in terms of optimizing cloud workloads, what that means is maybe you're keeping 5 years of storage data with AWS, or maybe you're keeping 6 years or something like that. And you're saying, well, these data logs aren't as valuable to me as 3 years. I really need to go backwards 3 years, but I don't really need 5 years. So I'll cut it by a few. And what that does for Amazon is provides a headwind to growth in terms of in terms of net revenue expansion for existing clients, and makes AWS growth more difficult to find. We saw a sharp slowing with AWS down to, I think it bottomed at 11% year over year. Google Cloud, same thing, but much smaller revenue base, much less mature, so it's still growing more quickly. And Azure slowed, but it also had maybe the first punch when it comes to the Gen AI wave, and really capitalizing on that demand, which has accelerated its growth. So that kind of selfishly, for my sake, left sentiment in pretty negative territory and allowed me to start a position. And it was just relying on the fact that secular growth for a company that owns 40% of e-commerce, and for a company that has the largest market share within the three-headed monster cloud computing race within public cloud environments, just relying on the fact that the pull forwards within both e-commerce and cloud computing would maybe not persist forever, and that comps would get easier, and that they would just continue on in their normal secular growth trends like they did in the decades before and moving forward. So it's extrapolating normal to kind of take this interruption from normal, and not assume that interruption is going to be the new normal. So a very weird way, I guess, of saying that, that's why I started the position. But now, not to Monday morning quarterback and to focus on where we go from here, I wanted to focus on the margin story for Amazon, and why it's kind of very exciting in my view. And I don't really like to use overly flamboyant language. As you can tell, I say kind of exciting instead of very exciting when it's a holding, but hopefully I'll get the idea across pretty well. So the first thing I want to talk about is the localization of their fulfillment network in North America. So they've gone from this national massive network to eight regional fulfillment hubs across the country. And what this does is it cuts miles to fulfill, it cuts touches per package, and it makes every single delivery that they're fulfilling more profitable overnight. So what we've really seen that translate into is an EBIT margin within North America now approaching, where did it get last quarter, to 4.9%. And just for context, Andy Jassy told us that he was optimistic that they get to 4% just a few quarters ago, and now he's saying there's more upside as of last quarter. They're going to report again tomorrow, so we'll see how they do. But just impressive margin expansion from North American fulfillment, and that's a main factor driving it, but it's not the only factor. And I will get back to cloud computing, but I do think the fulfillment business within Amazon is slept on maybe a bit more than it should be, just because this company has so famously been known for delaying profits and for investing profits into future growth and future success. And when Mr. Market says, well, now you have to show us progress and strength on the bottom line, this company has so many levers to pull within its fulfillment business. And I think we're just getting started with how that flows down the income statement. But sort of moving on within fulfillment and beyond this idea of regionalization, there's this idea of operationalizing, sorry, big word, operationalizing every single piece of the supply chain that Amazon touches. So they call this supply chain by Amazon. And really what it means is less deadweight loss. It means less wasted, and other products within it like Buy with Prime, which allow merchants to tap into its white label fulfillment service, which they haven't been able to in the past. Really what this is telling you is that they have excess capacity, and excess capacity means lack of efficiency, and that means less profit than that you could otherwise be earning. So they have this existing capacity, and now they're taking more effective advantage of it. That's going to flow down the bottom line as well. And again, that's why we're seeing things like a 5% increase in EBIT margin for North American marketplace year over year last quarter. And the very last thing that I want to talk about is the Flex program that they're working on with drivers. And it's really small business owners that they're targeting. Think of a beauty salon owner who works 4 hours a day, has 4 hours on her hands, and she's bored and she wants to deliver packages. Well, now Amazon, in a somewhat Uber-like fashion, so they don't have to treat them as full-time employees and can treat them as contractors without benefits, and it is cheaper labor, are able to use these workers or small business employees or owners for a few hours a day to really fulfill excess demand whenever they need to and whenever these people are available. So really just fine-tuning the fulfillment chain, the supply chain, to ensure that they're extracting as much value as they can out of every single phase of it, and making sure the dead weight loss or inefficiency is minimized at every turn. So where I see that going from here is, and you can see it in sell-side analyst trends where profit estimates are just exploding through the roof, and they're not really slowing down, which is why Amazon trades at 60 times EBIT, operating income, because they're going to compound operating income at above a 60% clip for the next few years, according to sell-side analysts. But really where I go from here is when estimate trends are rising, they generally rise more, and when they're falling, they generally fall more. And there are so many tailwinds and so much momentum within Amazon's business right now in terms of these secular tailwinds starting to blow again and allowing more demand to create more leverage on the income statement, or all these other margin levers that I talked about. It really is an interesting time for Amazon shareholders, I think, obviously, as a shareholder, but that's pretty much why. I can pause Brad, or move on to Matt and Uber.
Yeah, well, quick question. Let me just say, I mean,
Sure.
I'm picking myself up off the floor. I mean, you are amazing, Brad. You're a walking encyclopedia on Amazon, and you just, I mean, at your age, I was just tying my shoes, and it's really amazing how knowledgeable you are. Two quick questions, very quickly. So, iRobot, I think you had some sassy comments, if I recall. I mean, a lot of people saw the news about the acquisition. It's kind of getting rebuffed. And generally, international sales went down. Is that a currency thing, or what are your quick thoughts on those two things?
Yeah, so starting with iRobot, I refuse to get political because I really don't have any political opinions. I know you're not asking me to, but I just for throwing that out there first and foremost. But it doesn't make a ton of sense to me that Microsoft can buy Activision Blizzard and Amazon can't buy iRobot. I guess the FTC is very focused on preventing the cornering of the Roomba market or something, but I think that they're maybe focused in the wrong place. It's really not relevant for the Amazon bull case. They can build a Roomba on their own, maybe slightly more expensively than buying it, but it's just strange in my opinion. I'll use the term strange. What is allowed to be purchased, what isn't? And with the JetBlue Spirit Airlines deal that was just blocked, a lot of people make good arguments that, well, they were cornering the discount airline market, and that could lead to pressure on less affluent people, which is not good. And that's what the FTC's job is, to protect consumers. But I don't really understand how they're protecting consumers here or preventing some powerful monopoly from taking place. But
Lena Khan's looking for a win somewhere.
Yeah, so good for her. She got the Roomba people, those evil Roomba people. But in terms of you're international, so there are large foreign exchange headwinds right now, as you rightfully pointed out. In terms of, let me see if I don't have the exact year-over-year growth metric or what the FX neutral comp was, but there is a large FX drag there. I'll just point out that the margin tailwind that I missed, and thank you for reminding me this, punting the question, but sort of relatedly, is that North American has been the profit driver within commerce, and international has really been a massive profit drag, because it's sort of like Amazon Marketplace, but 12 years ago when they were just in growth at all cost mode and not making any money. So that just inflected a positive EBIT as well, because they are belt tightening, which also has something to do with the fact that they're not growing as quickly there, because I believe they are pulling out of some of the less profitable, more speculative markets and focusing on some others, like we see PayPal doing, like we see many other companies doing. But that is the reason for the negative growth. But another, I guess, prospect to look forward to, in that the international business is no longer going to be a nuisance in terms of profit growth going forward.
Got it. Got it. Cool. All right. So why don't we just,
Cool.
so I think it's 8:25. So why don't we Meta if we're doing
Yeah.
alphabetical, I guess. Yeah.
Let's do Meta. So Meta's another example of a company that was sort of left for dead and came back. I won't. I feel like I victory lapped a little on the Amazon position, so I'm going to skip the part where I say, well, it was obvious that these things went well, but I'll focus on where Meta is now and sort of where it can go from here. So the thing that's so great about Meta and why it has fared so much better in this post Apple app data tracking and data sharing world is because it has half of the planet on its apps, and because it has this massive first party data chest and knows exactly through trial and error and through actual experience and through endless split testing what works best on these apps and what doesn't. So really what that means is a shift from content where you're going on Instagram to see your friend or to see your sister or your cousin to more discovery based content. And TikTok really was the trailblazer there, and everyone sort of copied them, as Meta so successfully does with Snapchat stories and all the other things that it's ripped off. But I honestly say that as a compliment, because I mean, why not see what works and use it for yourself? But I digress. So really what Meta has at its disposal is this massive first party data chest. That's really what I want to talk about. And in the world of its apps, and in the world of generative AI, which is the next frontier in terms of where Meta's going in metaverse, Gen AI, that kind of that kind of intersection. But starting with apps, and I'm going to try to slow down and convey these ideas a little less scrambledly. But starting with the apps, what it does is it allows them to surface content that's more relevant to you more frequently. It juices engagement because it knows exactly what you want to see. And for me, it's golf videos and cooking videos and things like that. And it knows that's what I want to see. So as I scroll through this discovery feed, it knows what I'm clicking on, and it's learning from that. It's learning from that every single touch point to build an unmatched customer data profile that it can use across Facebook, across Instagram, and even across Messenger and WhatsApp as it kind of taps into advertising revenue there, which I'll get to in a second. But first party data, incredibly important for the apps, but it's also incredibly important for its entrance, its segue into generative AI. And really what it means is Meta has this jump start in terms of model training and model inferencing, which are the two main parts of making these generative AI models actually valuable and actually work. And it's because what trains models? A lot of data and a lot of relevant data. And that's exactly what Meta brings to the table. So that's the first part I wanted to go to, but then just wanted to talk about its overall philosophy towards generative AI and how it maybe counters some of the other players and how it mimics how Meta has really approached monetization in the past. So we've seen with Microsoft and their Copilot product, Amazon and CodeWhisperer, they are creating these generative AI add-on products and applications that they're selling via subscription. Microsoft the most directly by far. With others, ServiceNow, smaller companies. I mean, small, it's still massive, but smaller than Microsoft because everything is. But also adding on these generative AI tools. But what Meta is doing is really, it's open sourcing everything. So what it's doing is saying, hey, third-party developers, we have this massive first-party data chest. We just spent billions of dollars with world-class talent building these foundational models. It's called Llama, or Llama 2 is the most recent one. So come build for us. And what does that mean? It makes Meta the low-cost provider and the low-cost innovator because these third-party developers are coming in, incentivized by all the traffic that Meta brings within its apps, to build customized apps for them. And really where I'm getting with this is that foundational models like Llama, like Amazon's Bedrock, all of them, OpenAI's, ChatGPT, and the models powering that, they're going to become a commodity in the future. It's going to become a race to being the low-cost provider. And in my mind, open sourcing your foundational models and inviting the world to come build on it, so that you have great products, which attracts more people, which then attracts more developers to come build more things, and the flywheel spins. It's just a compelling place to be in for Meta. And it's an interesting place. It sort of reminds me of Apple and people have made this comp before, so I don't want to pretend like I just invented it. But Apple iOS versus Google Android, and one being this very closed ecosystem, and the other being this open source ecosystem where Samsung can use Android as the operating system to power their phone, and so on and so forth. But the other place where this whole commoditized, okay, so I'm sort of getting ahead of myself. What I wanted to say is that they're commoditizing these foundational models so that they can have all of these products to be the low-cost innovator and to create more compelling apps, which they eventually monetize with better engagement and more advertising, which is holy grail of how they make money. But that's happening in another very interesting place for the business right now, which is an endless hole of cash burn, and a controversial hole of cash burn, but still something that they're pushing forward in, with the Quest headsets and the entrance into the metaverse, which they started when they bought Quest. But where am I going with this? It's just it's kind of juxtaposing the approaches for Meta versus Apple in this case, and what Apple's doing with their World Vision. I don't even know what it's called, Vision Pro, or it's called Vision Pro. And so what Meta is doing is they're selling this hardware at a cost. I think gross margin they don't disclose, but I would assume it's pretty close to 0%. And really what they're trying to do is flood the market with all this hardware, again, to attract third-party developers, because they want to develop for consumers wherever the consumers are, to build them more compelling apps so that Meta can upsell subscriptions and sell apps in their app store and make money elsewhere. But really, it just flies in the face of what Apple's trying to do in terms of their typical approach to hardware, where we're going to rely on this dynamite ecosystem they have, this world-class ecosystem where I need to have a blue text bubble, otherwise I'm going to lose my mind. And for our international friends, that's how the mind works in the United States. But they're going to sell their Vision Pro at a 60% gross margin, and they're going to rely on this massive ecosystem and the fact that, well, I'm talking to you on my MacBook Pro with my AirPods on, with my iPhone sitting next to me, and my watch in my drawer, and they're relying on the fact that I need everything to match, I need everything to work together. So I'm not saying one of these approaches is better than the other, but I am saying it does also mimic this Android versus iOS contradicting approaches where they both ended up working pretty well. And I just think there's this duopoly showdown happening or rolling out before our eyes in the metaverse, and then there's this oligopoly or a few large players rolling out in the foundational model building world, whether it's Amazon or Microsoft or Meta or little guys too, like Hugging Face or like Anthropic or like OpenAI. So exciting times for them. Should I talk about the investment case a little bit for Meta? I kind of nerded out in terms of product philosophy, but I can cover that for a few minutes, or I can go to Uber.
Yeah, sure. I'd say very briefly. And the other thing I was going to ask is, I noticed SG&A, the sales, general, administrative, and marketing expenses went way down for Meta recently. Is that a good thing, or are there like metaverse? I think they backed away from their metaverse investing. Is there a chance any of that stuff was bundled in there also?
Absolutely. They are. I would say they are narrowing the focus within the metaverse. So they're shutting down some projects, but they are pushing full speed ahead with others. So I think there was some AR hardware tool that they just announced that they're ending. But from an SG&A perspective, one of the most powerful sources of leverage there has really been kind of what we're seeing with Google right now, what they're trying to do with removing middle management layers. And you can conduct layoffs, which layoffs stink, and it stinks for everyone involved. But just speaking in a purely emotionless manner, from an investment case standpoint, you can conduct a very small layoff with middle managers earning $200,000-$300,000 a year, and that can really add up in terms of payroll savings. So it's things like that. It's things like that wouldn't show up in SG&A, what I was just about to say. But in terms of overall cost savings, extending the useful lives of their data centers to lower depreciation and amortization costs, or in that case, depreciation, and just general cost cutting in terms of Mark Zuckerberg just really focusing obsessively on every single line item, like he did starting in late 2022, and figuring out where they can get leaner, where they can trim fat, where they can not offer acai bowls and sushi rolls for all their employees all day, every day in cafeterias, and where they can get serious about how much real estate they really need and maybe how much they don't in the new world of work from anywhere. But a lot of cost-cutting initiatives have really been showing up, and it's been fun to watch play out on the bottom line.
And is it acai or acai? The little beet, the berries.
Oh, did I just out myself and how called?
I don't know. I'm kind of out of myself as well. Yeah. Anyway, so yeah, well put. So it's 8:34 Eastern time. So by the way, I own, as you can see on the screen, I own Meta. I'm not in love with Mark Zuckerberg in terms of, I'm not convinced that he's necessarily always a force for good in this world, but as a platform, I'm not betting against it. So with that said, Brad, what about Uber as your final stock?
Sure. Yeah, Uber, I'm gonna focus on competitive differentiation and really frame my conversation around that. So for Uber, it comes from two places, and they sort of interlock. So it all started with Travis Kalanick, and if anyone watched that limited series Super Pumped on, I can't remember what streaming service because there are 80 of them now, but with Joseph Gordon-Levitt, it really got into Travis Kalanick and how crazy of a human being he was. And to his credit, Uber needed a crazy human being. They needed someone to say, and I quote, "We're going to buy revenue at all costs," to cut corners and to raise money like a madman during an age of free money and low interest rates, so that he could build scale and could get a very, very low margin business to effective scale to actually make money. And what happened after that is someone, Dara Khosrowshahi, I think I pronounced his name correctly, but if I didn't, I really apologize. Who's the new CEO of Uber, really came in, and he is the, I'm not calling Travis Kalanick a child, but Dara is the adult in the room. He is the seasoned operator who will take this gigantic revenue base and see all of the low-hanging fruit for cost cutting that exists and really take advantage of it. And really what that's meant is things like backing out of doing autonomous driving all on their own and partnering with Waymo over at Google or a bunch of other startups on it instead and outsourcing that R&D, or things like not hiring so aggressively and conducting layoffs, unfortunately, or not irrationally paying drivers incentives to a point where you're losing money on every single ride over and over again. But it
worked, right? I mean, Uber turned a profit in 2023, and that was the big thing. Is like, will this model even work? I remember this from years of analysts said, "Will it work? Will it work? Will it work?" And they cut way back on the R&D. Looks like, and finally they did turn a profit.
Yeah, and to your point, very low margin business, so the margin now is not gonna make anyone's jaw drop. But just for trends, their GAAP net income margin over the last 3 years has gone from -35% to 2.5%. Free cash flow from -17 to 10. So they've really effectively trimmed the fat. But to stand out, you can't just endlessly cost cut. You have to have competitive differentiation, as you very well know, James. And they get that in a few places. So really, Travis being this madman meant they had the most demand, meant they had the most riders and the most share. And supply follows those drivers or follows those riders and builds this endless feedback loop. And what that means for Uber is I wait less time on average than I would for a Lyft or for another competitor elsewhere, like Didi in Asia. And the other thing is I pay less surcharge because there's more supply, so there's a more efficient market, and there's less premium, and consumers are happy, and drivers are okay with this because there's more demand, so they're making more money anyway because they're not sitting on their phones for half the day and they have rides. So really what that means is that Uber's left with this idea of how do I keep the demand? How do I keep all these drivers incentivized to stay? And that's really where their product suite kind of shines versus everyone else. This full suite of transportation products, whether it's transporting you food or a computer charger or sending you or sending you a rider to go to an airport in an SUV with your friends. Or ahead of time scheduling a ride, or just traditionally ride hailing and fetching a cab, or not a cab, an Uber on demand to go to a restaurant or anything like that. Internationally, many more products localized per market, like motorbikes in India, so on and so forth. But really what that means is their customer acquisition cost is lower than everyone else's because most of their revenue is coming from existing clients who are being cross-sold other products. I just bought Sweetgreen the other day, and I'm going to hop in an Uber tomorrow. Uber's not paying any customer acquisition costs. They're not paying for marketing to get me. They got me. And how do they keep me? They keep me with Uber One, which is their subscription, which now makes up 25% of their revenue. And by offering me more value, and they're able to offer me more value because their customer acquisition cost is lower, and they can pass some of that savings on to me via letting me save $2 or $3 on a Sweetgreen and making me feel good about only paying $22 for a salad instead of $25. But it's a story for another day. And really what that means is happy customers who aren't going anywhere, which reinforces that customer acquisition cost advantage, which keeps customers there, which keeps the driver base bigger than everyone else's, which keeps that service edge in terms of both surcharge and wait times intact. So all of this has meant that the financial effect of this cause of this marketing advantage is that they have the best margins in the space. Lyft is not even close to making GAAP profitability in North America, and margin leads are true elsewhere, and that coincides also with Uber working less hard for this demand while they're also taking more market share because of these service advantages. So just a good place to be, and best margins has meant best balance sheet, which has meant lowest cost of capital, which now means Uber in this higher interest rate environment, like James was talking about, where non-profitable competitors are able to spend not as aggressively on growth because they have to show progress on the bottom line. Uber can just take more market share, and flex its muscles during when times are bad, and then accelerate growth when times are good. So it's really been this formula of creating more value for customers, of creating a better experience for customers, and for using that network, that loyalty that you built to make sure that drivers are coming back to you, and you make predominantly first, second, and third before they go to Lyft or another competitor outside of North America. Again, financial effect has just been exploding margins, exploding free cash flow, guidance of consistent operating leverage for quarters to come, guidance of continued explosive free cash flow growth. In a company that trades for, I don't have the exact number off the top of my head, but a PEG ratio, which is just, I know most of you probably know this, but price to earnings divided by earnings growth. And I use a 3-year earnings CAGR to kind of smooth out any growth noise year over year. But a PEG ratio well under 1x in the eyes of Peter Lynch, that is objectively cheap, and it's especially cheap for a company that's compounding revenue at a 15% clip as far as the eye can see and expanding margins. So the story's been good for a long time. I think Uber is just now, not just now, over the last 6 or 7 months, has been really rewarded for the story being good, because this isn't the company that it was in 2020, where I myself was saying, this company's 10 years old, 11 years old. They're nowhere near profitability. What are we even doing? Why does it even exist? And to that they said, not so fast, as the famous Lee Corso would say, and really turned a corner, and are here today. So still very cheap, still a lot of financial momentum. Like Meta and like Amazon, earnings estimates are just going higher and higher and higher, and that's why it's a top 3 holding right now.
It's really amazing, Brad. I was in the same boat as you. A couple of years ago, it looked like a race to the bottom in a commoditized industry. People were throwing money left and right, willing to lose money. It looked like nobody was going to win, and somehow Uber won. And it's really, you got to give credit where credit is due. And it's that low PEG ratio. I mean, people criticize the PEG ratio because you're comparing a linear figure to a geometric figure, but as a rough cut number, it still says something, and it says something good about Uber for sure.
Yeah, and Uber won with Uber One. So there you go.
I like it. I like it. Brad, thank you so much. You are amazing as always. Hope we can do this again sometime. And if you are hearing Brad say, this is not enough Brad Freeman, I want more Brad Freeman, stockmarketnerd.com or at Brad Freeman on X/Twitter. There are fake accounts pretending to be Brad Freeman. I'm going to tell you on Twitter. So do not fall for the fake account. Make sure you're looking at the real. Don't look for any dots or underscores. It's just the real plain Brad Freeman. And it's more than 125,000 followers, right? So that means you're looking at the real account. Yeah, and the fact that imitation is the sincerest form of flattery, right? So the fact that there are so many fake Brad Freemans is a testament to the caliber of the real Brad Freeman. So Brad, thank you so much. If you have any questions for either of us, let us know. I got a few questions we got in advance. I'm just going to answer those quickly as well. Let me, pardon me, I'm just going to turn to my phone where I have them here. Okay, someone has, does BBAE, it's about the app itself, work only on manually or on autopilot algorithm? I think the question is, like, can you get some kind of automatic money management? The answer is yes. There are 3 steps very quickly. Self-trading, do it yourself. We have a kind of a Discover tab, which is suggested ideas. And in fact, Brad's content appears in that Discover tab, but you yourself will pull the trigger on those. And then we have a separate, essentially a wealth management RIA division where we have products. And one of them I'm very excited about is Market Grader. And this is not advice or a plug per se, but it's something that it's basically a smart beta product. And there are 3 different variations of this. You just put your money in and it'll roll automatically. So maybe that's what this questioner is asking about. So if that's you, Eric, just check out the website and you'll read more. One more quick one, and I think we got one submitted on YouTube as well. Trading is a new interest for me, and my biggest question is how to place a trade. Like, what do all the boxes that need to be filled out mean? Okay, that sounds like a logistical question. Market order, about the type of order. Market order means you're going to buy at the current market price, and that's normally what I do if I'm buying a long-term liquidly traded security that I'm going to hold for many, many years. If you're trading a thinly traded small cap or micro cap, you probably do not want to put a market order on because those prices move quite a bit. You'd put a limit order on, which means I limit my trade to this exact price. If I get it, great. If not, I'm willing to walk away. Otherwise, you have a stop loss order, which means if the stock price drops to a certain level, try to sell. It's not a guarantee, by the way, that you're going to get out, but they make an effort. If just everything blows up, you could blow past your stops. But generally speaking, it's a layer of protection. And then on the upside, there's what's called a buy stop, which is typically if you're short the stock and you want kind of a stop loss on the upside, you'd buy to cover that short. And I think there's market on close order. You might see on some brokers that's just market order at the closing price of the day. So I hope that answers your question about logistical trading questions. Brad, we got one. He says, a question for James, is the tech sector going to bounce back instantly and get to new highs once interest rates come down, or is it baked into the price already? Something about inventory, and I'm sorry, there's actually like a heart on my screen or something. Maybe it suggests something about inventory and ETF. So I'll answer as much as I can read about this question. So tech sector bounced back. So we got two factors in play here. The interest rates are going to come down, which is supposed to be good for tech stocks. Any kind of stock, when the lower the interest rates, the less differential there is in a discounted cash flow model between money coming in a year or 2 years or in 10 years. The higher the rate, the more differential in a present value sense there is. That's why when rates were super low for 13 years, we had this boom in biotechs and the early stage tech stocks, because they're far off into the future's cash flows were worth relatively more in a PV sense, present value sense. So from that lens, declining interest rates is a good thing for tech stocks. However, I think you got to keep in mind the elephant in the room, which is what some of those slides earlier said. Big tech valuations are really, really high. There's a big valuation gap from large cap and small cap. Gaps can close in two ways. It's not always the small caps go up to being valued like large caps, right? Large caps can go down, or large tech stocks, I should say, can go down too. So I would juxtapose the rate falling like kind of benefit against the valuation detriment and probably give a little more weight to the valuation. Brad, you may be able to answer that question better than I. In fact, you probably can answer that better than I can. What do you say to that?
Is tech going to immediately rebound?
Yeah. Are falling rates going to be good for the tech sector?
I know it's going to for the tech sector specifically. I think it comes down to one of your ideas from earlier of balance sheet leverage, and a lot of these tech companies, at least the ones I own, they have no debt, or they have massive net cash positions. So I guess in my mind, I focus on companies that are profitable. Predominantly, I have one company in my portfolio that is not GAAP profitable, and actually they would benefit a lot from rates falling. Coincidentally, it's Lemonade, where they're an insurer, and a fall in inflation means their premiums immediately get more profitable overnight. But there are so many examples like that, where for maybe like an Upstart, which is not personally holding, but I know is a popular company for others, they're so reliant on capital markets, on capital market funding supply for their own growth, for this tech engine that they've built, that falling rates means tighter credit spreads, and them having more access to that and growing faster. So many relationships like that, where cost of capital falls, I can be more aggressive investing into growth. I can take advantage of what James was saying, in that I don't have to show immediate progress on the bottom line, can invest in the future profitability. So from a flexibility perspective, I think it's absolutely going to be a positive for them. In terms of is it priced in or not? If I knew, I'd be Warren Buffett 2.0 and riding off in the sunset. So that is the age-old question: is it priced in? We shall see.
And you still may be Warren Buffett 2.0, Brad. You still got
I'm not.
A lot of time ahead of you. So.
I'm confident in that.
Brad, I know you're super slammed with earnings season. Let me just one more quick question for you, then we'll let you go, Brad. It says, question for you both. So I'm going to pose to you, Brad, first. I'm all cash now. All cash. Wow. And want to buy VOO. This is the Vanguard S&P, the Vanguard equivalent of the SPY, just a little bit lower expense ratio. Is there any good time frame for me to do this? Maybe waiting for a pullback in February or March. It's a lot of money to me, not salary DCA, dollar cost averaging. So apparently this person has a big block of money, relatively speaking, wants to know, should he or she buy VOO now or wait a little bit?
I'm of the opinion that if you're going to be in index funds, you should be invested. And and maybe being calm and being tranquil is also very important. So if you're going to put 100% of your money in, and a 10% decline is going to make you give up, then that's not what you should do. So I
Yeah.
think you should invest as large of a portion as you comfortably can.
Yeah. And let me just jump in and say, I'm sorry to interrupt, Brad, but just to be clear, like, neither of us were, like I said at the beginning, we're not giving personal investment advice. So we're speaking general opinion to, just people writ large. But, anyone who's asking questions, we're not like telling you what to do, to be clear. But sorry, Brad, carry on. I think your answer is dead accurate. And that's exactly how I feel too.
Sure. Yeah. And like you said, different circumstances dictate what the right decision is for everyone. And part of that is how you feel internally and sleeping well at night. So do what's best for you, not financial advice. Yeah. So I'll say that. But if it were me in my position, I'm 26 years old. I don't have kids. I have disposable income and income coming. I would put all of it into VOO right now, and just know that I'm going to dollar cost average every single week with the disposable income I have, and know that when I look in 10, 20 years, the stats that James gave apply perfectly to this conversation, that history tells us markets will be higher. It could always not happen this time, but it would be a pretty big anomaly. So.
Excellent. And just pile on with a stat. I mean, depending on whose data you're looking at, the stock market is positive in 70 something percent of years. 71%, I've seen 73%, I've seen higher than that, but 70 something percent of years. So in general, that's an argument against dollar cost averaging. I mean, the argument for is that's just when you get the money, okay? And you're going to, you earn money, you plunk it in, you earn money, you plunk it in, right? So that's more a matter of practicality. But if you have a big block of money, generally speaking, with that 70 something percent stat in mind, it's just mathematically better to deploy it all at once rather than drip it in.
Yeah, and maybe if you decide not to, make sure that money's at least earning something in a high yield savings account, so that you're getting paid.
Exactly. Awesome. Well, thanks everybody. Thank you, Brad, very much. Thank you, Brad, for joining us.
Thank you.
I think I learned a lot from watching it, and I think we all did. All the audience did as well. Just a quick conclusion from me. I'm going back to this Morgan slide. If there's one thing that I can impart, is just patience wins the game in investing.
That's so
you don't need to make it complicated. You don't need, and generally the more complicated investing, like the worse the investing. Play it simple. That's usually the best way to do it. Thank you guys. We'd love to have you at BBAE as a customer. If you're not already, I know a lot of you are watching. If you fund your account, you get up to $400 in bonus money, and you'd make us really, really happy. We've got great customer service, real people to talk to, not some like AI chatbot, like actual real human beings. We're happy to have your business. We'd love to welcome you into the BBAE family. Just go to bbae.com to learn more. Brad Freeman, on behalf of you, on behalf of me, James Early, and on behalf of BBAE, thank you guys so much for watching, and we'll see you in the next webinar.
Cool. I think it was freezing.